Hello, you're welcome to the Business and Trading Hub. Today, I want to share with you 10 smart money concepts you must know to become a pro Forex trader. 10 smart money concepts. 10 smart money concepts you must know to become a pro Forex trader. 10 smart money concepts you must know to become a pro Forex trader. Now, these concepts will enable you to master the Forex market, to become better at trading, and will help you to make better calls that will ultimately lead in profitable trades and profitable trades essentially. So number one, let's go straight into it. Number one is order blocks. Order blocks. The first smart money concepts you must know to become a profitable Forex trader is order blocks. Okay, order blocks, which is also known as OD. Okay, so order blocks refer to a group of pending orders placed at a specific price level by smart money traders, such as large financial institutions, hedge funds, big banks. And these price levels, these pending orders, can cause or is expected to cause a possible price reversal. Okay, this level or positions called the order blocks are possible reversal locations for price. Okay, so order blocks are a group of pending orders that are being placed by big financial institutions, big banks, hedge funds, that are expected to cause a reversal in price. Okay, these are order blocks, and we have two types of order blocks. We have the bullish order block. Bullish order blocks. Okay, we have the bullish order blocks and we have the bearish order blocks. Bearish order blocks. So you need to know about order blocks. So order blocks are important concepts that money traders know, smart money traders know, in order to trade the Forex market. So I have made a previous video. I've made a video on order blocks and before. So you might need to check out that video to be able to trade, to know what order blocks are in detail. But let me show you an example. Like for example, this is a bearish order block. This is a bearish order block. Okay, why is it a bearish order block? Because it causes a reversal in price. It causes a reversal. It's expected to cause a reversal in price. Okay, that is a bearish or a bullish order block. This is a bullish order block. Bullish order block. Okay, so it causes a reversal, a reversal in price, a bullish reversal in price. Okay, for a bearish order block, we have, let's look for an example. This here is a bearish order block, and it's expected to cause a reversal in price, a bearish reversal in price. So this is a bearish order block. So as I've told you, I've made a detailed video on this, so you might want to check it out. Now the second concept you need to know to become a pro Forex trader, the second smart money concept you need to know to become a pro Forex trader, is the concept of supply and demand zones. Okay, so supply and demand zones. Essentially, supply and demand zones are almost the same thing as order blocks. Okay, the same thing as order blocks. The supply zone is actually a zone whereby price is expected to reverse in a sell direction, okay, which is also same as bearish order block, while a demand zone is a location in price level where the market is expected to reverse in a bullish direction. So the demand zones is same as bullish order block. So we have considered two subjects now. We have looked at order blocks and supply and demand zones. So you can as well use the concept interchangeably. Supply zones are area in price where the market is expected to reverse in a bearish direction. The market is expected to sell on a supply zone, while the market is expected to buy when it gets to a demand zone. So the supply zone is the same as the bearish order block, while the demand zone is the same as the bullish order block where price is expected to buy. All right, so now let's move to the third concept. The third concept you need to know why if you want to become a professional smart money trader is the concept of market structure. Okay, the market structure, MS, the principle of market structure. So what is market structure? Market structure is actually refers to the overall market direction. Okay, direction or flow. Okay, and the market structure can be bullish or what? Or bearish. Yes, you're right, bearish. Okay, so market structure actually refers to the overall market direction in a particular forex instrument or forex pair. All right, so you can either have a bullish market structure or a bearish market structure. Now, for a bullish market structure, the market is making higher highs and higher lows in this fashion. So this is the higher high, higher low, higher high, higher low, higher high, higher low, higher high, and higher low. This is a bullish market structure. Okay, so but for a bearish market structure, the market is making lower low and lower high, lower low, lower high, lower low, lower high, lower low, and lower high. Okay, so this is a bearish market structure, bullish market structure and bearish market structure. So this is the market is in a bullish phase here, or market structure here, while the market here is in a bearish phase right there. All right, let us see it in the chart. As you can see here, this is the market is making higher highs and higher low, higher highs and higher low, higher highs and higher low. So this is a bullish market structure. Okay, now let us look at a bearish market structure. Let's see if we can have one. Now this is a bearish market. The market is making lower low and lower high, lower low and lower high. Okay, lower low and lower high, lower low and lower high, just like that. So this is a bearish market structure. Okay, so that's the third concept of smart money. That's the third smart money concept you need to be aware of. So the fourth smart money concept we need to be aware of is the concept is the concept of order flow. The concept of order flow. So essentially, order flow is the same as market structure. When you hear of order flow, it's just the same as market structure. So order flow actually shows the overall market trend, the overall market trend, the overall trend of the market, which we just saw now, is the same as the market structure. We can have a bearish order flow or a bullish order flow. So market order flow is the same as market structure, which I've just shown you as an example of. So when you hear market structure is the same as order flow. All right. So now the fifth concept, you need to know, when it comes to smart money trading is the principle of break of structure. Okay, break of structure. Okay, which we identify as BOS. Okay, when you see BOS in market in a chart, in a chart explanation, it means break of structure. Break of structure. Okay, you need to know about break of structure. Okay, what does break of structure mean? A break of structure is a situation whereby a currency pair or any other financial instrument breaks out of a well-defined price range. Okay, the market breaks out of a well-defined price range or pattern, and potentially signifies a change in trend. Okay, so I said break of structure is a situation whereby a currency pair or a forex instrument breaks out of a well-defined price range or pattern, okay, which potentially signifies a change in trend. Okay, so now let me show you the break of structure on this chart right now. Now, when the market makes a lower high, this is in a bullish phase. In a bullish phase, you have something like this. Market makes a higher high and higher low. Okay, higher high and higher low. Okay, like that. So this is a break of structure to the upside. This is another break of structure. This is another break of structure. And this is another break of structure. So this is a price range. This is a price range which price broke out of. This is another price range which price broke out of. Another price range which price broke out of. Another price range which price broke out of. So that is a break of structure. Like in this case, this is a break of structure here, break of structure here, break of structure here, break of structure here to the downside. Okay, break of structure to the downside in this case. But let's see, in a bearish phase, we have market break structure to the downside, break structure to the downside, break structure to the downside, and break structure to the downside. So the market broke structure from this point, breaks this structure, breaks this structure, breaks this structure. The market breaks structure to the downside, which we call the BOS. Okay, so in a bullish phase, the market breaks structure to the upside, breaks structure to the upside, breaks structure to the upside. Okay, the market breaks structure to the upside. So that is a break of structure. Now, the sixth concept you need to know while trading the smart money concept is the sixth one. Is called the liquidity. It's actually called the liquidity grab or stop hunt. Liquidity grab or stop hunt. Okay, liquidity grab or stop hunt. Okay, so what does this mean? Liquidity grab or stop hunt is a situation whereby institutional traders or hedge funds raid or take out the stop losses of retail traders intentionally. Okay, liquidity grab is actually a situation whereby liquidity grab or stop hunt is a situation whereby large financial institutions, hedge funds, or institutional traders take out or raid the stop losses of small retail or retail traders. Okay, so and they do this intentionally because they have more funds, they have more money. They trade a forex market with more money, and for this reason, they can actually determine the direction of a market. They pump in more money into the market and take out the stop losses of retail traders. So we have about three types of we have basically three types of liquidity. Three types of liquidity in the market. I've actually made a separate video on each of these concepts I'm sharing with you. I've made a separate detailed video on each of these concepts I'm sharing with you. So I'm just doing a highlight of them. Now, in that video of liquidity, I made a separate video on liquidity. In that video, I mentioned the three types of liquidity. I said we have range liquidity, we have trend line liquidity, and we have equal highs and equal lows liquidity. Okay, we have range liquidity, we have trend line liquidity, we have equal highs and equal lows liquidity. Now, for the range liquidity, the price could be going in this fashion. The price could be going in a range like this, and you find out that the smart money trader might maybe the retail traders might maybe place their stop loss right here, expecting price to sell further, only for this and this. When they place their stop loss right here, the market may have formed a pattern of like a bearish flag pattern, and the retail stop losses will be right here, only for the smart money traders, institutional traders, to see that your stop losses are here, and what they do, they just reverse the price. Okay, instead of selling, the price buys, and all these stop losses are raided. This is because this is a range. So this is a range liquidity. For a trend line liquidity, you have price reversing on a trend line, successfully reversing on a trend line. Okay, and now you place your stop loss here as a retail trader, expecting that when price comes here again, it would reverse, only for price to come right here and take out your stop loss. These institutional traders take out your stop loss right here, and the range that you placed on the other side of the trend line. Okay, now for the third type of liquidity is the equal highs and equal lows liquidity, whereby you have price makes an equal high like in form of a double top or double bottom. Okay, and at this point you have price like this. You expect price to respect this equal high so that price will sell, but the market comes to your equal high and take out your stop loss. Same thing as for the equal low, like in form of a double bottom or triple bottom, as the case might be. We expect price to come right there and reverse, but price give you a piece of the cake. The market gives you a piece of the cake, and you enter a buy trade, and all of a sudden the market sells, taking out all the stop losses that were placed behind the other side of the equal low. All right, so these are principles you need to be aware of as a smart money trader in order for you to be better at trading. All right, so now let's move to the I've made a separate video on each of these concepts. I've made separate videos, which I'm going to be linking on the description box of this video. I've made a separate video on each of these on each of these concepts, so that you can be able to go into those videos and view them. Okay, I make detailed video that helps you to become better at trading. So you might want to go to each of these videos. I'll be linking on the description box to view them and get a hold on this concept. So the seventh principle, the seventh smart money principle I feel you should know in order to become better at trading is the principle or the concept of imbalance. Okay, the concept of imbalance, and some traders call it FVG, which means fair value gap. Fair value gap. Okay, so what is imbalance? What is fair value gap? What is imbalance? Imbalance actually means, or it refers to, a situation whereby the supply and demand for a currency pair are not equal. Supply and the demand for a currency pair are not equal. This is what imbalance means. So there is no balance between the demand for a currency pair and the supply of that currency pair. So imbalance actually can be caused by a variety of factors. So imbalance can be caused by a variety of factors like economic data release. It can be caused by economic data release. Imbalances mostly occur temporarily. Can be caused by economic data release. Can be caused by geopolitical factors or events. Can also be caused by market sentiments. Okay, market sentiment. Okay, so that is imbalance, and that is fair value gap. So it's actually a situation whereby the demand is not the same as the supply. So, and I've told you, I've made a separate video on imbalance, and I've said that imbalance principles, like for example, when a high impact news is being released, and a high impact news like your FOMC, like your usual and monthly this monthly news that comes out every Friday, first Friday of the month, which is called the NFP, even your CPI. So these can cause imbalance. When these economic events are released, you can have imbalance. Market could just shoot up all of a sudden, and I've told you how to trade such market. So because the market will have to do some form of correction. Okay, and when you have seen such imbalance, the market will actually correct itself. So it's a good, when you have seen a sign of correction, you need to sell. All right, so, and maybe the market, this high impact news is being released, you could have also a bearish imbalance, and then you wait for a correction, and you can actually enter a buy trade. So I've actually made a separate detailed video on imbalance, so I would want you to check it out. I'll post it in the description box of this video. So the eighth concept or eighth principle you need to know about smart money is the principle of change of character. Okay, the principle of change of character. Okay, so change of character is similar to break of structure, but it's not actually the same as break of structure. It is actually similar. Some traders mistake both for one another. They are not the same. A change of character refers to a sudden change in the behavior or direction of a currency pair in a currency pair's price action. Actually, this change can be identified by a break in the previous high or low, and it indicates a shift in market sentiment. Okay, it indicates a shift in market sentiment. Now, let me just give you a very brief a description of what this change of character means in comparison with your usual break of structure. So the market makes a higher high, higher low. Okay, higher high, higher low, and at this point now, the market now breaks structure. Let me help you to understand it better. Now, the market now broke structure to the other side. This is break of structure, break of structure, break of structure. Here you have your change of character. So now change of character signifies a change in trend. Okay, now after you've had your change of character, you now have your break of structure again. Continue having your break of structure. Okay, break of structure. All right, so you are in a bullish phase and all of a sudden the market breaks structure, and that break of structure, that the break of structure that causes a reversal in trend, is called your change of character. Now this is your bearish change of character. Now for a bullish phase, the market is making higher lows and lower lows and lower high. Okay, lower lows and lower high. And now this case, now the market now breaks the last structure, reverses in trend. Okay, now in this case, this is a break of structure, break of structure, break of structure, break of structure. But here, whereby the market now transition to a bullish phase from the bearish phase, you have your change of character, and after that you have your break of structure and break of structure. All right, so this is actually this is a bearish order flow to a bullish order flow. All right, so that is change of character for you. I've made a separate detailed video on this as well, so you might want to check it out. So now the ninth concept you should know is the principle of inducement. The principle of inducement. Okay, the principle of inducement is a concept. I've made a separate video on this each of these principles. I've made separate video on them, which I'll be linking in the description box of this video. Okay, the simple principle of inducement. Inducement actually means a situation whereby the big banks, the big financial institutions, manipulate the price of a currency pair and deceive smaller retail traders. So there is inducement can also be called manipulation. Price is actually means price manipulation. Price manipulation. Okay, so inducement is a manipulation of price by institutional traders or high institutional traders, banks, big banks, hedge funds. They manipulate price in order to deceive small retail traders. Let me give you an example. Okay, for example, these hedge funds and big banks, they would at some point initiate a false market move. They initiate a false market move in order to attract retail traders to enter a buy or a sell position. They enter a buy or a sell position only for them to now reverse that move. Okay, so they would enter like a sell position right here, and when you have seen the bearish candle, the market is actually in a sell mode. Now when you now get in as a retail trader, they would reverse the position, hit all your stop losses, or take out all your stop losses. This is price manipulation. Now for they would also want to enter like a buy position. You see the market appears to be in a bullish phase, and now when you now get in right here, you get in right here, and the market now reverses. Okay, the market now reverses, taking out all your stop losses. So that is a price manipulation in a which is called inducement. Okay, let me see if I can see some form of inducement on the chart to show you. Okay, let me see if I could see some inducement to show you. Now, for example, here, this is an inducement. So they have induced you to sell. You actually started selling. Before you know it, they come to take out your stop losses. They come to actually take out the stop loss you have placed here. Okay, they give you a piece of the cake. You try to sell only for them to come and take out your stop loss, because this is like a supply zone which you have sold from, and they now come to take it out here. All right, let's see if we can see another example. Okay, like here now, this is a mini supply zone. So you see they start selling right here. You are thinking that the market is going to continue to sell. and now they take out your stop loss. They initiated a buy position, but there was an initial sell right here, and when everybody gets into the sell, they now reverse the market, taking out all stop losses that are placed right here. So inducement essentially is price manipulation. So I've made a separate video detailing this, how this occur. I don't want to make this video too long, so I've made a separate video detailing how inducement occur, how these hedge funds and big banks, how they actually carry out the inducements, and to the detriment of retail traders. Okay, now the final concept I want to share with you about that you need to know as a smart money trader is the final concept I want to share with you is the principle of mitigation. Okay, the principle of mitigation. Okay, what is mitigation? Mitigation actually refers to a situation whereby price comes back to fulfill pending orders that are left open or pending by institutional traders. So that is inducement. All right, when we call ourselves smart money traders or demand and supply traders, we do not have the amount of funds, the large funds needed to be actually called institutional traders, because we trade with lesser amount of money. But why we call ourselves the retail smart money traders or institutional traders, why we call ourselves institutional traders is because we actually trade in the footstep. We trade in the footsteps of big banks. We know when they are in the market, and we trade in their footsteps. We trade in the footsteps of big banks, big hedge funds, and the institutions. Okay, big financial institutions. We trade in their footsteps. So now, mitigation is a concept whereby, let me show you. You have a higher high, higher low. Okay, higher high, higher low. It is expected that price should come back to, this is an order, pending order. We expect that price should come back right here before it will now buy. So this is an unmitigated supply zone, demand zone, which you are expecting that price should come back to fulfill. Here again, you have market creates an unmitigated zone. So it is expected that price should come back to take out this, to activate this order before it continues in this movement. So in the same way, in a bearish phase, the market makes lower high and lower low. So in this case now, where this is an unmitigated supply zone, which we're expecting that price should come to fulfill and before it now sells. So this is mitigation. This is the principle of mitigation, a principle whereby price is expected to come back to fulfill an order that is orders that are left open or pending by institutional traders and big banks and hedge funds. Okay, that is it. So that's why we have the principle of mitigation. We have mitigated zone, and unmitigated zone. All right, so what we actually trade as demand and supply traders are, we actually trade unmitigated. We actually get into trades at unmitigated supply and demand zone. So we don't trade the mitigated zone. So we actually look out for unmitigated zone, areas in price whereby the market has not come to test. Okay, so essentially, unmitigated zones are fresh zones. So these are what we actually trade. Fresh zones, they have a higher chance, higher probability they have a higher probability of success. They have a higher probability of success. Okay, so I want to ask please that you kindly subscribe to our channel. Kindly subscribe to this channel if you have benefited from this video and many of my other videos. Kindly subscribe to my channel and also share my videos with your friends who want to improve their trading. I've got years of experience in trading in the forex market, so that is why I have the confidence to bring you these concepts from my years of experience. So share my videos, give this video a thumbs up if you feel that you have learned something from this video. And also I have a free YouTube channel. Sorry, it's not a free YouTube channel, a free a Telegram channel whereby I post chart analysis daily. Now, for example, today I posted this this is USD JPY. Today when we came to the market, I actually this morning I identified this zone. And I said that price was going to come, price is going to sell from this zone. If you check my Telegram channel, and that Telegram channel is in the description box of the video, I drew a, for those of you that are in my Telegram channel, you can see that I drew this zone. And I said that price was going to reverse from here, and you see how price reversed from here. This was a sweet sell-off immediately, just within 5 minutes that I posted this chart. Within 5 minutes within which I posted this chart, the market started selling from this zone. And people, I showed you a screenshot of a member of the free channel who actually traded this signal and made money, and made so much money. So you might want to join. In the description box of it, you're going to see the link to the Telegram channel. Okay, the free Telegram channel. I post free chart analysis that you can trade at your own discretion. All right, or in the profile section of this YouTube channel, you're going to see my Telegram, the free Telegram channel, link to the free Telegram channel. So get into that channel, trade profitably, become better at trading. And also, if you want me to mentor you in forex trading, you want me to take you by the hand and mentor you until you become a profitable forex trader, I also offer private mentorship, one-on-one mentorship. I believe in one-on-one mentorship. The reason is because I believe that each trader has his or her own, everybody essentially has their learning curve. So I am patient with training you until you become better. You make your mistakes, I correct them, and I coach you until you become a better and profitable trader in no distant time. So I want to thank you so much for viewing this video. Till I come your way next time, do have a blissful day ahead. Bye.